Today we're going to be discussing how to evaluate multifamily real estate deals. We're really going to talk about some high-level things that any investor should look at with one sole purpose: to make better investing decisions. So again, thank you for joining, and my goal today personally is to make sure that every minute you spend on here, you get maximum value for that time. So I'll go ahead and just kind of go over a couple of introductions. Today I have a couple of special guests that are going to join us. I have Joe Milo. He's our head of underwriting. I'll say Joe is probably one of the brightest real estate minds that I've met in my career. He's been in the industry for over a decade. He's underwritten over $20 billion in real estate transactions with Barcadia. Also, I have our vice president, Tyler Evans, who's been in the industry for over 17 years. Started as a leasing person and managed over 6,000 units as he grew his career. So really knows how to look at a property and has his own lens. So everybody's going to be sharing their inputs today about kind of how we analyze risk, how we see opportunity. So as I mentioned, I introduced Joe and Tyler. Myself personally, I entered the multifamily space about half a decade ago. I've been building companies now for almost 2 decades. Essentially, I had a couple of exits, and I was in the same position as a lot of folks here. I built up my liquidity and kind of wanted to invest my own capital somewhere, and just didn't understand the industry at first, but I needed to deploy my own cash. And by studying this, I fell in love with the industry and tried to build this all-star team of people that came together to try to build Alliant Ventures. So a little bit about my background. Disclaimer, we're not lawyers, not attorneys. None of this should be taken as legal or tax advice. Obviously, we speak to lawyers and attorneys, so we're going to pass that information down, but we always recommend to pass it by your counsel as well. A couple of quick things that I want to note about what separates Alliant. I think number one is we're investors first and sponsors second. And when I say that, when we got into this industry, I deployed 8 figures of my personal capital because I wanted to look at deals as an investor. A lot of times sponsors, when they look at a deal, they might look at the fees involved or how much commissions that they might make. But when you're truly investing 100% of your own capital, you're going to look at risk differently. You're going to analyze deals differently. So I think that's one of the big things that separates us. Also, obviously, our team has 30 years of combined experience. We're local to the markets we work at. Joe is local in Dallas. Tyler lives in Houston. You have to have a pulse in order to be able to see the properties, manage the properties. So I would say those are a couple of things that truly separate us. And also our performance in a down cycle. The assets we did acquire did very, very well, outperformed when a lot of people had a little bit of a bumpy road in the past couple of years. First thing we're going to speak about today is talk about story, right? I think a big thing is understanding what is the story behind the deal. And I'm going to give you guys a couple of examples of stories that make sense and stories that should make you ask more questions. So I'll give you one. Let's say there's a 300-unit property and it's proven that it increased rents on 30% of the portfolio. And the plan is the sponsor is going to upgrade the other 30%, and they're going to leave 40% for the next buyer. Now, that story makes sense because, on a 300-unit property, if you took 90 units and you've proven that you can charge a premium for, let's say, renovated product, that's a big enough sample size, right? You're showing that there's 90 people in that market that wanted that product. Now, on the contrary to that, imagine it's a 300-unit property and only 10% of those units were renovated and achieved the rent bump. That to me would not be, sure, there's some evidence there, but you also don't know how long it took to get those 30 units. What if they held the property for 3 or 4 years and slowly filled them up? So you always want to look at how much of the units did they prove And the other question you should be asking, especially if you're working with a sponsor, is how much of the profits on this deal are dependent on these renovations? Because whenever you're doing renovations and you're looking at bumping up rents by offering a higher quality apartment to people, there's always some level of risk of, is the market going to accept that? Is the market not going to accept that? When you're looking at deals, you want to be able to look at a deal and it's still profitable and could deliver above market returns without any renovations. So at least when we underwrite a deal, we like to see a value add opportunity, but we never want to rely on the value add opportunity as being the main driver for delivering profits on the deal. The other part of that story that I want to mention is you want to ask your sponsor, how much are you leaving for the next buyer? Okay, so if a big part of the business plan is renovating the units and then leaving some for the next buyer so they can acquire the property and they could renovate the rest, then that business plan has to make sense. But if you're only leaving 10% of the units left for the next buyer, you want to ask your sponsor, when you plan on selling this deal, whether it's a 3-year hold, a 5 or a 7-year, that's usually the range, you would want to ask, what's in it for the next buyer? How are you gonna position this exit? So I would say that's one of the things that I'm always looking at is how much of this business plan is going to rely on renovating units and trying to prove a market premium. So another big one for me personally is it's a combination of a couple of things. Rent growth plays a very critical role in how the asset and the investment is going to perform as a whole. Now, in order to try to forecast rent growth, sure, there's a lot of reports out there like CoStar and a lot of data providers that could say 3%, 4%. How accurate those are, I mean, it's a gauge. However, there's some things that I like to look at, and the first thing is, what is the rent-to-income ratio? So the rent-to-income ratio is how much is a person spending out of their income for their housing. If it's above 30%, 35%, I would say that's about average. Anything below, I would say 30% is good. Anything below 25% is great. I would say anything above 40% would be kind of a red flag, because what that's saying is that already 40% of my income is going away towards my housing. So how much more room is there to bump up rents? And again, commercial real estate values are so heavily driven by the profit that's produced by the property, and rent growth plays a big part in that. So you want to first ask yourself, what's the rent to income for this neighborhood in a 3-mile radius, preferably? Anything below 25, really good. I would say 30 is about average. But then you want to ask, what is the vacancy in the market currently today? So if the vacancy is 10% and the rent to income, for example, is already at 40, that would make me personally a little bit nervous on how are we going to be able to increase rents when there's already a 10% vacancy in the market, and so much of people's income is already going towards their housing payment. And then I would take a third factor and put it into the equation, which is how much new supply is coming on the market. So it's kind of this 3 different metrics, but they're all pointing in the same direction for me, is how bullish am I about rent growth in this market? So I'm going to take the rent to income ratio, I'm going to take the occupancy, and I'm going to take a look at what's the new supply coming on the market to paint a holistic picture and really try to get comfortable with the rent growth assumptions that are being made in the market. So like I said, a red flag would be 40% rent to income, 10% vacancy in a market. There's some new supply coming, and for example, a sponsor is projecting a 4% rent growth. That to me would be very bullish and aggressive underwriting. So those are kind of some stories that we see consistently repeating in the multifamily space and some questions that you should be asking. Joe, I'd love your view on some of the things that you take a look at through your lens.
Sure. Thanks, Arnold. I've added a scenario in here that I've seen this year. So on the left side, we got the tale of two value capital structures and business plans. On the left side, this is a value add deal that is for one financed conservatively. The sponsor here is using 70 to 75% leverage at a kind of current fixed rate of 5.5%. The business plan on this one is the upgrades are light. They're generally operational in nature, meaning that they are driving income or value add creation without requiring major capital outlays. So they're not necessarily spending 10,000 on a unit to renovate it and hopefully get a $200 rent bump. They're doing things that are ancillary income drivers. They're probably optimizing expenses, and there's different ways to do that. But this setup is really a strong risk-adjusted setup because it doesn't require speculative capital outlays, and it has very predictable debt service. And then on the right side, this one, by contrast, is a lot different. They're still using that same 5.5% fixed rate, probably agency debt. They're getting 65%. But then to make up for that leverage, or to amplify their leverage, they're also adding in a preferred equity piece on top of their senior debt at a 14% rate. Preferred equity, while it's called equity, it operates exactly the same as debt. And so the capital structure of this deal is up to 80% leveraged. Now, that higher leverage can amplify your returns, but also the risk. And especially why it's concerning on this one is because that business plan, in contrast to the left side, is heavily dependent on interior renovations, which are very capital intensive and speculative because in the market today, many markets with consumer sentiment and people's willingness to pay higher rent for upgrades, it's not always
Yeah.
there.
Yeah.
So on this one, now they're relying on one, they perfect execution just to meet those projections. However, their margin for error is much thinner due to the higher total leverage, which is amplified by that preferred equity.
That's a great point, Joe. You know, a lot of these capital stacks that we're seeing, they boost returns, right? So your IRR, instead of a 15, it's a 17. Your equity multiple is higher, but you know, you have this higher leverage, and the more leverage in a deal, the more risk in a deal. And especially with preferred equity, because preferred equity, if something goes wrong on that deal, the reason they're called preferred equity is because they're in first position to recover money. So it's not just about what the returns are on a deal, but how heavily is it levered. And Jill, like you said, not only the leverage, but it seems like to me you're looking at leverage and how complex is this business plan to execute.
Mm-hmm. Yeah, in short, yeah, you mentioned the 15% versus the set. You could make a 15% IRR projected be a 17 by layering on leverage. But the takeaway with these two scenarios is it's not just about the return on paper. It's also about how realistic the business plan and how durable that return is under adverse conditions. And that's what this comparison really shows.
Yeah, and some takeaways that I think everybody on this webinar could take is really question the sponsor's business plan. So questions like, how are you improving the income on this property? And when you're listening to their plan, think about how complex it is, right? Are they just cutting some expenses to get to these numbers? Or are they talking about a $300 rent bump where the market didn't fully justify it? And then asking also obviously about how is it leveraged and things of that nature. And as you keep seeing deals, you're going to get a pretty good sense on business plans that are just not realistic and look good on paper versus business plans that are based on something solid. So that was a great perspective, Joe. I know you had one more here. I'd love for you to share.
Yeah, so I have another example that I've actually just recently come across in the real world. I guess background on this one is kind of in Texas, in our markets, Houston and DFW, you see a lot of this. You see people looking for, like I was speaking to in the previous example, non-capital intensive and less risky ways to increase revenue or increase net operating income, and thereby creating value and equity. So on the left side is an example of a business plan where, and this is an actual real world example I just saw, where the sponsor was talking to a nonprofit organization, and in exchange for basically putting a cap on the rents that they will charge during their hold period, they are receiving a 50% tax abatement, meaning effectively they're paying 50% less taxes. And here in Texas, taxes are your biggest expense on a property. So that's a big needle mover. Um, However, what we also see in all these nonprofit arrangements, that they're often, most of the time, specific to that particular owner, not specific to the property, the asset. And so when you see someone present this, first question needs to be, well, is this tax abatement transferable? Because if they're projecting a 5-year hold, on the left side, the sponsor knows it's not transferable, is upfront about that. And when they project their sale, they're assuming that the buyer is going to be buying the property and having his tax assessment reverted back to full market value. This is conservative and realistic, and that's the way to do it. On the right side, it's what I've seen is, the sponsor takes the same abatement but fails to account for the property taxes resetting upon sale. This oversight basically overinflates the projected NOI for the next buyer, and ultimately the exit value that they're presenting upfront 5 years, when they buy the property. This makes the deal look better than it actually is, and it's unfortunately a modeling mistake that I've seen a few times here lately. But that was just a very specific real world example I wanted to include.
Yeah. Yeah, well, I didn't see that deal, but I guess we skipped over it for the right reasons. And I also want to loop Tyler in. So Tyler sees almost every property, definitely every property in the Houston area for us. So he has his own view on things. And T, I know you put a couple of examples in this presentation as well. Love for you to share.
I'll go ahead and dive into my example and kind of explain it. So, right, we're talking about stories that make sense that actually work on deals. Anybody out there who's looking at deals, you're probably going to see this in their pitch, which is adding ancillary income, which that's basically anything that they're charging residents in addition to rent. So this makes sense when the total rent amount plus the ancillary income actually fits in the market. Right. And it's something that's wanted or needed by the residents, something that they perceive as valuable, and they're going to like that. For example, if you add laundry inside their unit and they didn't have it before, and you're charging them $50, that's likely something they're going to welcome and enjoy that as an amenity. However, if your property, most of these deals, they're already adding upgrades. And then in addition to that, you'll see people adding cable, valet trash. Those are all things that look great in your model, but if that makes your property top of the market or above market rate, and the people don't perceive that as a value, for example, there's dumpsters right outside every building. Now you want them to pay $25 for somebody to walk 5 feet and throw it away for them. That's going to create resentment from the residents. And although it looks great on your model, it's probably going to backfire in the long run and create more turnover. People are going to go down the road to that property that has those amenities that they actually value. So that's when people put those in to try to juice those models up. You really got to look at the comps. and be like, does
Yeah.
this make sense in this market? What research have you done? Are other people doing this? Right? These are all questions that you can ask your sponsors to try to
Yeah.
get comfortable because, yeah, it doesn't always work. We've seen one
Yeah.
recently where we were looking at a deal and we were thinking about adding cable. We did research, and then there's a provider there. Everybody's getting all their cable and internet for like $25. And the cheapest we would be able to offer is $50. Imagine if you're the only property and you require everybody to pay $50 when they know that nobody else pays that. They're going to be mad. And they're going to likely, just because of that, they're going to try to go down the road. So, prime example. So,
Yeah. Yeah, that's a big one too, Tyler. I'm glad you brought it up because a lot of folks today are kind of moving to the newer assets, the 2000 built, and the whole business plan on the newer assets today is really adding that extra revenue. And you've really got to ask a couple of questions. If the business plan is heavily based on adding that ancillary income, a couple of questions, like Tyler said, is how do you know that the residents are going to adopt this service or this fee? What market evidence do you have? What proof do you have? Did the comps charge this? You can also ask this very simple question, which is how much is the property currently making in other income versus how much are the comps making in other income? And what are you planning on getting this property to in other income? Now, again, that's if the business plan is heavily reliant on that as a revenue stream. Those are some of the questions that you want to ask to kind of gauge a picture of, okay, so these folks are paying, let's say, $1,500 a month, and we're going to come in and we're going to slap on another $300 a month in cable, trash, God knows what else people are creating nowadays, but it has to make sense to you. How would I feel if I was the tenant? Would I want these services? And that's a big thing we're actually seeing in the market today. That's a great one to bring up. Also, I want to mention, I should have mentioned this in the beginning, but if you have any questions as we're talking, please drop them into the Q&A section. We're going to leave about 10-15 minutes to answer any questions that might arise. But Tyler, I know you had one more example that you wanted to share.
yep. Yeah, sure thing. So the next one is, sponsors' assumptions, realistic versus perfect world thinking. So, good sponsors, they make assumptions that align with what's actually happening in that market. Also, with what their team has successfully executed before. So, a prime example of this is renovations, right? We do on a lot of our deals a standard renovation package. So I know, it's going to take roughly 7 days to install the upgrades of flooring, right? So I have a timeline from vacant to move-in ready. Now, if your sponsor hasn't done that before and, they just say, oh yeah, 5 days, we got this. That's an example where they put it on paper, sounds good. It's going to reduce their vacancy timeline, but some markets, it's hard to get good labor. Smaller markets in particular, you have, maybe a slower turnaround time. Another example is your vacancy timeline in general. For example, what is this submarket's average days vacant per unit, right? How quick are they leasing up? So if you're actually a good sponsor and you're looking at your vacancy percentages, your lease up rates, all this data, that's available out there, and you're basing your actual model and your business plan on that, you're going to have a lot more success in real life versus, aspirational numbers where if a business plan only works if everything goes flawlessly, all of your vacant times are 25 days, period, regardless of delays in make readies, delays in leasing. Sometimes people don't move out on time. They don't turn in the keys and you can't get that unit renovated, so you have to file an eviction. That's going to take you longer to get that new rental rate, so
Yep.
there's always delays, there's always things that come up, but you really need to study the market that you're in because every submarket is different with its statistics, its trends, the things that, as a good sponsor, you have to know to create the right business plan. It's not a one size fit all. And although that looks beautiful in a model and on paper, in real life, it doesn't go to plan like that.
Yeah, absolutely. Anybody can make a bad deal look good on paper, right? You put garbage in, you get garbage out, right? So it's not just about what people are advertising as the returns, it's really what's behind that. And I'm going to jump into a couple of more things here. One is the next thing that you really should dive into is who is doing the property management. This is critical. If you think about it, the people that are doing the property management, they're the ones that are making sure that the tenants are happy, fixing leaks, toilets, making sure rent is collected. The property management team is absolutely critical to success. So there's really two options. One is it's going to be done internally, which is done by the general partner. And usually that's kind of the best scenario if they have a lot of experience running properties. Now, the reason why it's always good for the general partner, the sponsor, to have their own internal property management company is because it's their property. That's their baby, right? They're incentivized to get it to perform. Now, when you work with external property management companies, now they're also incentivized, but here's the nuance. External property management companies are incentivized usually, I would say 99% of the time, by gross revenue. So yes, they want to drive the gross revenue on the property up, but that's not what truly drives the full value of the asset. It's the net revenue. It's after expenses. So a challenge that happens with external property management companies is they're not looking after the expenses the way maybe you would if you were running it. So now it's a very common practice, and we have our internal property management, but on select deals, we might do external property management. But our business strategy is a little different. We built our internal property management company where if we put a third party in and they're not performing, we could come in within a week's notice and take over the property and do what we need to do to get it up to speed. I mean, we had one of these situations, and I'll tell you a funny story. One of these situations with one of our assets where the property management company was doing a horrible job. And I remember it was Valentine's Day. Tyler rolled up his sleeves, literally with his wife, went there to live on property for 2 weeks, fired the property management company, lived on property, got it up to speed. Now, if we didn't have our internal property management company, that deal would have died right there. So if somebody is using external, you want to ask them a couple of questions. You want to say, number one, how many of your properties have they managed? What experience do you have with this property management company? So you want them to have worked with you in the past with the sponsor before. The other question that I would want to ask is, how did you vet them? How did you make sure that this was, the right company to work with? And, like a process that we do, for example, if we're hiring a third party to oversee one of our properties, we're not going to ask them for referrals, right? Because they could always just give us, here, call these 2 or 3 people and go get a referral. I'm going to ask them for a client list. I want to know all of your clients that you service in this area, and I'm going to randomly pick which properties I'm going to show up to and see how they're operated. Because anybody could give you a couple of clients or a couple of assets that they just have a really good team there, they're managing them well. So you want to hear your sponsor doing that level of diligence where they're really going and secret shopping how that third party property management company is running the asset. And then you also want to ask them, what contingency do you have in place if they underperform, if they don't do the job that you expect? Another question that you want to ask is, property management companies, they're incentivized on gross revenue, which is great. You want to get higher income, but that's not net revenue. So what are you doing as a sponsor to align interest with the third property management company where they actually care about the bottom line? So for example, we will try to structure deals where we're going to give bonuses at the end of the year for NOI performance. right, to incentivize them. Now, there's no third-party property management company out there that works on strictly net revenue, so that it just doesn't exist, at least none that I've found or heard of. But there are companies out there where we'll come in and we'll say, look, we want to take off all of these kind of junk fees that you have, maybe the construction fee that you want to charge us, or, and instead let's do a performance bonus. If you hit our net revenue numbers that you're committing to, then you're going to get X dollars or Y dollars. And this way you're creating some type of alignment of interest. So that's a little bit of background that you want to ask who's doing the property management company. If it's the sponsor doing it, great. How many properties do you manage yourself? If it's external, did you do business with them in the past? How did you screen them? And how did you set up the deal to make sure your interests are aligned? Those would be my big questions for any sponsor on any deal, doesn't matter. Especially value add deals, right? If you have a value add deal that is operationally heavy to lift and bring to plan, it becomes even more important.
Yeah, no, great point. It's, Class A deals and Class C deals are two completely different worlds. So if you have a group who does Class A stuff, typically, and they got a C value add, you might say, well, how are you gonna, make that switch? Because it's much more intensive. So great point there, Arnold.
Yeah, yep. Joe, this is you, my friend. Location, location, location. By the way, this is what I hear from Joe all day, every day. And obviously, we all heard the saying location, 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 but Joe will dive in and give some nuances to that.
Yeah. So this is pretty general, but there's a few interesting points that I would like to touch on. Obviously, I'm sure we've all heard the saying that you can fix the property, but you cannot fix its location. That's certainly never been truer in multifamily. You can, especially in the value add space, you can do all you want to improve the property and make it pretty, but your scope of control only extends to your property line. And a good location will bail you out of mistakes, I guess I would say, but a bad one will certainly magnify them. The other point I have on here is development's not always bad. Development, it certainly signals a renewed or ongoing investment and confidence in the area, and speaking to development in general, whether that be retail, employment, office, that sort of thing, but also multifamily. When we're talking about value add, particularly, if there is a brand new, if you're owning an older vintage property with average to moderate rents, and there's a developer who's come in and investing the money to build a brand new property with rents that are $500, $1,000 higher than you, that's not always necessarily bad. The key is whether the new supply complements and or competes with your property, but it's good sentiment for the area. The other thing I'd say on here is for us, when we're evaluating location and neighborhood, a submarket, we like to sit back and before looking at data, just sit back and really ask the question, why would someone actually want to live there? And that goes, things that go into that are all the things that you're aware of: job diversity, school quality, lifestyle, the lifestyle amenities, access to transportation. But taking a 50,000-foot view and asking that question is where we typically start. And I also have in the slide here, in our markets, which are Houston and DF, Dallas Fort Worth metros, specifically in those markets, school district that's generally the first thing that I look at when I get a property and an opportunity to evaluate. I see what school district it's in. The Houston and DFW metros are extremely large suburban metros. They extend far outside of just the actual cities of Houston and the actual cities of Dallas. They're made up of dozens and dozens of suburbs that all have their own school districts, and the suburbs can be generally similar in a lot of ways, but one thing that they are all different on is the quality of their schools. And when people residents of these metros determine which suburb they're going to live in. More often than not, it's that deciding factor is the school district and the quality of it. Um, so I wanted to put that point on. I also put the if you're doing your own research at home, niche.com has kind of become the industry standard. That's where most people go first. You can look up school district specific schools and really and get their rating, and that's very important for location assessments in our markets especially. We already talked about, Arnold had mentioned on a previous slide, we love the rent to income ratio. So without going into that again, that's the average income of the neighborhood and what the rents are at the property. If it's kind of below 25%, we love that. But also touch on Google Streets. We see hundreds 150 deals so far this year. If we get serious about a deal, of course we're putting boots on the ground and walking the neighborhoods and doing our research. But a great way to assess a location just on a first pass is getting on Google Streets, type in the address, start walking around the area, look for, are the lawns maintained, or cars in good shape? Is there the property right across the street? Is it dilapidated? You're really looking. You can by Google Streets, you can really get a good feel for pride of ownership in the area, and that can give you a very good initial feeling on a location if it's not one that you're particularly familiar with.
Yep.
But that's it for me.
Yeah, no, I love that. And I think that just goes back to how underwriting is really not only just a science, but it's also an art, right? You can't just fully rely on a spreadsheet to give you a model and think you're going to make good investments. You need to have both. You need to be able to have a feel for what's going on, as well as understand modeling and what's conservative and what's not. So I love the Google Streets, Joe. So T, I know working capital and reserves, this is you all day. What can you share about it?
Like the little subheader there, cash is oxygen. Deals don't die from NOI misses, they die from running out of cash, right? And I think, the last couple of years, this is more important than ever, and just kind of a note, when you have reserves and, CapEx buffers, it does not help your deal look better. It does not make those returns more attractive, right? So a sponsor
Right.
might be motivated to run it without them, or, a tight line to make those numbers for the investors look, hey, that's a great deal. Ooh, 19 IRR. Oh, it's a 2.2, right? And that's again, paper versus real world. So, reserves are a beautiful thing for everybody involved that's actually invested in the deal, because reserves buy time. They let you recover from delays, cost overruns, slower lease ups. As we discussed, things don't always go to plan. In fact, they
Yeah.
rarely go to plan, right? There's going to be a delay. That material is going to cost more than you thought, right? You tear that siding off and oh man, look, so when there's CapEx work.
Yeah.
So what we do is we look at the useful life of the stuff that's in the property. For example, it has a boiler that's 20 years old. They last 25 to maybe 28 years old. Okay, so it works now. We have it inspected. It's great. But during our hold period, there's a pretty good chance we may have to replace that entire boiler.
Yeah.
So we're going to hold a reserve for that, because if you don't, and that happens, well, guess what happens to all the investors' cash flows? It's now diverted to fix an issue that you have to fix. And if there's not enough cash flows, now what kind of mess are you in, right? So
Yeah.
also, roofs, plumbing, HVAC, all of these things have a useful lifespan. So when your
Yeah.
sponsor's doing due diligence, they have to not only look at does it work now, but how much longer is it going to continue working?
Yeah.
And when it fails, where's that money coming from, right? So that's the CapEx reserves and buffers, which again, we like to hold not only a 10% buffer, but several hundred thousand, because you
Yeah.
don't know what's going to come out of it, right? Once you start digging in and now that price just went up. But then also your operating reserves, right? Again, if you're projecting 90% occupancy and your renovations are running behind, or maybe there's a backup in stoves and you can't lease them up because of that, right? So now you have a shortfall in cash flows. Well, these reserves give you that time to continue operating successfully. They don't interrupt cash flows to investors. They allow you to have a cushion. But the point is, they do not make the returns look better for
Yeah,
investors. So
yeah.
so it's definitely something
That's
you want to ask your sponsor. What reserves do you have? What's your plan?
and just as an example, when we're looking at a deal, especially if it's like an 80s vintage, and we identify, let's say, $300,000 of work we need to do, I'm slapping on another 400,000 minimum of things that I didn't see that I just know are going to come up. And by putting that $400,000 on, sure, I'm not going to be able to go out to market and present as sexy returns as maybe somebody that just completely doesn't. But what happens when you don't is you burn bridges, you burn relationships. Then you got to start making capital calls, right? When you don't have that buffer and you didn't budget for it at all, now you have to call people and say, hey, we need more money to operate the property, right? I'd much rather have less attractive returns, but realistic returns that we could deliver on, but not only deliver on, but outperform. So Tyler, I think one or two questions that people could ask their sponsor about reserves, what would it be?
Yeah. So how many months of reserves do you have planned, right? Do you have
Okay.
3 to 6 months in operating reserves budgeted, right? So that's number one. Number two is the same question, but with CapEx, right? How tight is your CapEx budget? Do you have a buffer and do you have a contingency reserve, right? So, and the other part of that is, have you forecasted the useful life of the major systems on the property? Like I said, the boilers,
Yep.
the roofs, they do have a lifespan. So you have to look at that.
Thanks, T. That's great. And real quick, I want to share with you guys a deal that we're currently just finished all due diligence on. It's a 200 unit Class B in Houston. If anybody is interested at looking at the opportunity, just give you a couple of quick highlights about it. I think one is it's a 7% cash on cash return, which is very healthy for today's market. We love deals with a healthy cash on cash return because it kind of just shows, there's money every month, right? You're not waiting for some big exit at the end of year 5. And also that 7% is actually with no renovations needed to be done. We're cutting down some expenses that are super overinflated because they have a very expensive property management company on site. So a lot of little tweaks there. Also, it's about a 17% IRR. It's a 2x multiple. I will say this, I've been seeing other people's underwriting in the industry. I think most people would be marketing this as a 19, 20% IRR. But I'm not going to go there. It's very conservative underwriting. If you want to find out how we got to our numbers, more than happy to send you our models, performas. We got our email on top. Feel free to shoot us an email, invest@investav.com. A couple other things I really love. It's the best school district in Houston. So going back to location, incredible location. I think we're at a 22 or 23% rent to income. So tremendous amount of upside for rent increases. And we're only projecting 3% a year. So there's significant amount of room to outperform that just based on what the comps are charging and how low the rent to income is in the area. And a couple of other big things is we're buying this deal 100% with our cash and people could come in and join us later. So this really de-risks the deal for folks. If you think about it, like when people just go into a deal, they haven't completed due diligence, their insurance isn't final. There's so many things that could still change on our pro forma. Actually, personally funding this deal 100% from my balance sheet. And then obviously we're going to take on investors who are interested in the opportunity. Last thing I would say is we're going to keep 20% of our equity in the deal. So we're going to have some significant skin in the game. I would say that's a couple of highlights. Joe, Tyler, I know you got your own things you kind of love about the deal. Maybe you could share a bullet point or two.
Go ahead, Joe.
Sure. Yeah. So yeah, this deal, it all the boxes that we like to see that we've talked about already. This one checks: location, very low rent to income. It's actually on their current rents. It's 21%, which is what we like. The deal is we've talked about light business plans before. There's a lot of nuances about this one. which I could get into in detail if anyone wants to later. But it's a very light business plan where the high level is the property has been rents have been self-restricted because the equity in the current ownership equity has chosen to do that because of the type of fund it's in. Basically, the 25% of the units are artificially leased at 7.5% below the other 75% of the units. So day one, with new equity coming in, not self-restricting, we're getting a 7.5% rent bump without having to put any capital in. So for all those reasons, we love this deal.
Yeah.
Yeah. So for me, I love that it's one of Houston's strongest submarkets, right? Consistent with population, job growth, top ranked schools, as Arnold mentioned. You can literally see the growth. So I've been out there, every, several times a week for the last month and a half, 2 months. And you could just see, development here, retail center here, new employer there. Some of these submarkets you see where it's just you see vacant buildings, it's kind of dwindling, right? And this is more the opposite. You could feel the growth. So, in a 5 to 7 year hold, we're going to see a lot of opportunity there for increase in values. So I love it for a hold. Just makes
I
sense.
would also add to it that the ownership provenance is a big thing that we hadn't mentioned, but we really look for in opportunities. By that I mean who is the current owner, who's been the current manager for the last 5 to 10 years. In the case of this one, the seller is a $1 billion institutional fund, and they've had Graystar as their manager for the last 7 years. So you've got an institutional owner and manager who are running the deal, which they're not short on capital. They've had a big pride of ownership and have maintained the asset to Class A standard, which gives us a lot of certainty coming in and something we look for.
Absolutely.
Yep. So again, if anybody wants to get the model or any other information, feel free to email us, and more than happy to send you any information you'd like on it. And let's now continue and talk about rent growth. So I know I've been touching on rent growth a little bit, and again, I think for me the biggest factors that I look at is, well, one, I'll take a look at what is CoStar saying. That's a good baseline, and then some other data providers, I would say CoStar is kind of the main one. But you also have to use your own reason and logic. So the three factors that I'm looking at is how much new supplies come into the market. Now, like Joe said, sometimes new supply isn't always a bad thing, right? So if you have a Class C property and they're building a bunch of Class A, that's great. Right? That means that area is getting more revitalized, and that's not going to compete with your Class C. So it really depends on the type of product. So sometimes it's good, but if they're building similar product to you or just one class apart, so for example, if you're a high quality B asset and there's a lot of Class A coming up, right? That means that Class A might need to give concessions where they compete with your Class B, stealing some of your renters, right? So you got to look at it from that lens. So that's what's to come. The other thing, again, I'm looking at what is the current market occupancy, and you got to ask that to your sponsor, right? What's the market occupancy for this type of vintage asset in a 3-mile radius? Rules of thumb, I would say anything below 90% would be a red flag. That means that market is softening up. 95% would be great. 92, 93. I mean, you see things in the 97, 98 range. That means there's a lot of strong and healthy demand on a market level. And then the last factor for me is rent to income, right? Is how much are people already paying? And I'm going to take those three factors and I'm going to look at them holistically. Then I'm going to look at the CoStar data, and then I'm going to ask myself, does this make sense to me? Do I feel this is actually going to happen? So, Joe, in terms of rent growth for you or Tyler, is there anything else that you feel could be a relevant data point? Because it is such a big factor. Like if there are two things that you want to know about in your sponsor's model, it's like, what are you forecasting for rent growth and what are you forecasting as your exit cap? Those are going to be like two of the biggest needle movers. So, Joe, Tyler, anything else folks can ask their sponsor?
Yeah, I think for me, it's, one of the biggest drivers of population, which then increases your demand, is jobs. Like,
Yeah.
especially if they have a little bit higher rent growth, it's like, is there a new company coming? Is there new jobs? What's driving this? So I'd like to hear their insight on that.
And another key question you want to ask is, if they're already bumping rents, if they're coming in and they're doing unit renovations and they're bumping rents maybe $150 or $200, you want to ask, are you planning to also assume organic rent growth that year as well? That sometimes could be a little unrealistic, where you can't just come in, increase rents and assume organic rent growth. So that's another question that you could ask. If there's a renovation plan in place, could give you a little more insight into how your sponsor is modeling risk.
I'd also add that rent growth is very nuanced, meaning, is this property, where are the rents currently? Like, is this a property that's far below a lot of neighboring properties? If that's the case, then some higher rent growth could be reasonable. Or is this property the nicest property, achieving higher rents than everybody else? In that case, it's harder just on a percentage basis, harder to justify higher rent growth than if you're at the bottom of the market. I would add that.
Absolutely. Yeah, that's big too. And that's another question to ask your sponsor is, what are the comps currently? Are we top of the market? Are we middle of the market? Right? If you're top of the market already and you're forecasting another 3-4%, that could get a little dicey. But now I put this chart to really give you guys an example of how big of a driver this really is. And what this chart represents is, if somebody was to invest $100,000 into an investment, we took a deal and we kept everything the same, right? Just everything about the deal is the same. All we did was we changed the annual rent growth. Now, on this deal, if we assume a 4% rent growth, that means we can advertise that for every $100,000 somebody puts in, they will obviously recover their $100,000 and make $128,000. Now, I just want to show you the impact it has. If we go from 4% to 3%, that 128 drops down by 30,000. That's now 98,000. And if it's not really 4%, if it's 2%, instead of making $128,000 in profits, you're making $78,000 in profits. So this is why I really like to dive in on rent growth, because it is such a big driver of how that asset is going to perform. And hopefully we've equipped everybody here with a couple of questions that you can now go and ask when you're looking at deals to get a better gauge. So there's a couple of other, I have a slide here. It talks about a couple other questions that you can ask, right? Is how did you base your rent growth assumptions? If somebody tells you, I got it from the broker, that would be a red flag to me, right? Broker wants to sell the deal. You got to do your own research. If I was a broker, I'd be advertising 4% rent growth to everybody. But yeah, so want to ask, how'd you get, pretty simple question, right? What data sources are you using to get your assumptions? How did you come to that conclusion? And now that you got some of this knowledge, you could see how much they know. How does the property compare to the comps? And if you really want to see how detailed a sponsor is, you want to ask him, how do our one bedrooms compare to our comps one bedrooms? This will just kind of show you the level of diligence that they do. For example, when we're looking at a deal, we're not just, there could be one bedrooms, two bedrooms. We want to know how competitive we are on our one bedrooms compared to the comps. Then we want to know how competitive we are on our two bedrooms. And if we have three bedrooms, same questions there. So that's a good question to ask just to gauge how on top, of diligence is my sponsor. And then there's a couple of things that you could check as well. What I would ask is, who is the number one comp? Just give me one name. And you can go on Google Streets and you could put in the address and just take a look at the property. How does that property look versus the property that's being marketed to you in the OM? Right? If one of them is all beaten down then is it a true comparable? So that quick eye test could also tell you a lot. And it also tells you what people are considering as their best comp. if they're being realistic or not. And obviously we have here rent to income, which we've already spoke about. So I think with that, it should give everybody plenty of ammunition to tackle to tackle rent growth in a pro forma. All right, so as I've mentioned, besides rent growth, the next big needle mover, I would say, is your exit cap. And exit cap is essentially, what are you planning to sell this property for? Now, usually the rule of thumb in the market is you want to add about 10 basis points to your entrance cap for every year that you hold it. So I'll give you an example. If you're buying a 6 cap, something that's very conservative is adding 10 basis points for every year. So if you're selling it in year 5, then your exit cap should be forecasted about 6.5. I'm going to give you guys a little water cooler talk in the industry. If you're forecasting expansion on your exit cap, you're not going to win any deals in today's market. It's just unrealistic. Usually, it depends on the market cycle, right? Right now, we're at a market cycle where we had the largest rate hike in U.S. history. From COVID, we had a spike from 25 basis points on the Treasury to almost 5%, just undocumented, right? What that did to values in real estate, obviously, there's kind of been a huge discount, right? Right now, you're buying properties for 20 to sometimes even 30% less than what they were just 2-3 years ago because of changes in interest rates. Obviously, the Fed is cutting rates. People in the industry know that. So it's getting competitive out in the market today. So if you're just adding your 10 basis points, you're not going to be competitive, but you're also probably not realistic. What I would say is conservative underwriting for today's market is a flat exit cap. If you're buying a 6, you should assume you're exiting a 6. Me personally, I'm pretty bullish. I feel we're definitely going to have cap rate compression, but I'm never going to pencil that in an underwriting pro forma, right? So those are some of the questions that you can be asking your sponsor. Simple. What is the entrance cap? What are you going in at? And what are you planning on selling at? And if they sell you a whole story about cap rate compression, I would be personally concerned about that because sure, it may happen, but when you're underwriting, that's not what you bank on, okay? You bank on a conservative exit, and if it happens, you over-deliver for people, but you don't model it to make your returns look better. Tyler, Joe, any comments on exit caps? I know we talk about exit caps probably 20% of our week, but would love for you guys to chime in.
Yeah, the biggest thing I would say is it's the biggest unknown. I try to look at exit caps, an exit cap, not necessarily based on where I'm buying it today, but where the market is historically. Right now, we're in a cycle where exit caps are the highest, or I'm sorry, cap rates are really the highest that they've been in the last decade. And we see, based on many factors, including the biggest one being interest rates, and then we think rent growth is going to pick up again within the next 5 years. Those two factors do indicate that you could get some better market conditions when you go to sell in 5 years, which translates into a lower exit cap than maybe you're buying in at today. That's all great, and we love that, but you don't want to bank on that. When you're underwriting a value add deal, a tremendous amount of your profit comes at sale, not from ongoing cash flows. And so you just want to be careful how you forecast your exit cap. We tend to try to keep them as flat as possible, knowing that there's certainly a case to be made that you can certainly outperform that.
Yeah. This exit cap is another sensitivity analysis that we did just to show you how big of an impact exit caps have. So you could see the difference. If somebody invested $100,000 and the sponsor forecasted a 6, and you're making $100,000 in profit, if that exit cap is now 5.5, that profit drops from 98 to 78. If it goes to 5, it's now from 98 to 61. So having conservative underwriting there, where you're positioning yourself to potentially outperform it, I would say that is the way to go. And again, apologies that we ran a little bit over. I think we just got into one of our underwriting modes, but I'd love to go to Q&A, and any questions that you guys may have, love to tackle them.
All right, so we got Leo asking, why would the current owner of Green Tree Complex be artificially lowering the rent on part of the units by 7.5%? How could this be benefiting them? So Joe, you want to?
I'll take that one. So this was a big thing that happened in the last cycle. It was funds were formed with a goal to address what was considered a social cause, which was the lack of affordable housing. And when funds are raised under this target, they have to either buy properties that are already have affordable restrictions on that due to local municipalities or financing restrictions, or in the case of Green Tree, if they buy a market rate property in order to satisfy their SEC regulations and what they told their investors they were going to do, they have to self-restrict. So that's the reason that they're doing it. This is a market rate property that they picked up in their impact fund is what it's called. So it doesn't necessarily maximize their profit on the individual investment, but it did allow them to raise equity that they might not have had otherwise in order to buy the property. That equity specifically has a mandate to restrict rents. The biggest thing on Green Tree is that it's only 25% of the property, so it's a 200-unit property. 40 of the units are, as I mentioned before, leased at about 7.5% below the other 75%. So we're not taking an entire property and saying we're going to rate that rent level, that market rent level is proven 160 of the units. And we feel, comfortable with that. But I hope that answers that question.
Yeah, I think so. All right. So the next question is, how do you incentivize third-party property management companies, and what KPIs do you use to monitor it? Right. So I'll mention on KPIs real quick. So there's really kind of two different sets of KPIs. You have, early leading KPIs, which we monitor a lot, and then there's lagging, which would typically be your monthly numbers. So early indicators would be your traffic numbers on leasing. We do have access to kind of weekly invoices, so we could see what the spend is trending at. We do have budgets for every line item, whether it's, repairs and maintenance, plumbing, whatever it may be. So if they start approaching thresholds, we could, ask questions, get insights, and that's all from asset management perspective. So as far as the lagging indicators, obviously we have, occupancy statistics, we have our spend on all the different line items. But as far as incentivizing them, Arnold, maybe you want to.
Yeah. Look, incentivizing. I have a very unique strategy, and it's before I start talking about NOI performance bonuses, I show them the deal and I have them commit to how high do you think you can get the performance of this property on expenses, on revenue, and I really wanted them to believe in it. I want to see them tell me, yeah, we could cut this down by X and increase this, and I'll really drag that conversation on until I get to the top dollar of what they feel they could do. Now, once that happens, usually besides a 3 or a 4% property management fee, they'll have a bunch of other fees, like construction fees, and that could all add up to another 1 or 2%. So what I'll do is I'll come in and I'll say, look, we're going to need to scratch that. Remember all those numbers you said you feel you could do on the NOI? We're going to convert all those bonuses if you hit your NOI target. And now I create more alignment of interest. And FYI, that's why we call the Aligned Ventures Aligned, is we're all about alignment, not just with property management companies, but with investors. I think you could tell just our level of transparency, but just everybody we do business with, right? So, but it's about creating that alignment. It's now you're incentivized to get that NOI up and not just charge me for construction or some other miscellaneous fees. So I would say that's the process, right? Come in, get them to believe in the property, have them drive up that NOI number, where they're literally selling me, yeah, we could do this on the property and that on the property. And once I get that number, I say, okay, great. So now all this other income that you want to earn, that's going to come if you hit that at the end of the year. So it's about finding people that are willing to work on those terms. But when you do, those are the properties that you're just going to be able to sleep better at night, right? You know, these people are incentivized for your end goal and your end result.
Yeah, and I think to add to that, something that we really pushed was having some of that incentive flow down to the people on the site, right? We want the regional to get something, we want the property manager to get something, right? Because when they know that they're benefiting, they're going to smile a little bigger, they're going to be a little nicer to the customers, work a little bit harder. And at the end of the day, that's what really drives the success of the property. So we always try to make sure that it's not just the people in the office at the management company that get that bonus. We want it to be the people doing the work who are at the site each day. So that, in my opinion, makes a big difference as well. Question is, so is the plan on Green Tree to increase the 40 below market rents? And I'll say, yes, absolutely. You know, it's a great submarket, rents are in demand. So we'll be eliminating those artificial reductions and lifting them up to market, which, you know, the beautiful thing about this one is that it still puts, even if we bring them up to market, it's still cheaper than several of the other properties in the area, and you get a much nicer product. So we expect that to be received really well.
Yeah. And for reference, we calculated how much that is increasing the value of the property. That one policy change that we're doing is increasing the value of the property by $940,000. So it's a very kind of easy lift. 160 of the units already are paying full market. Every other comp is paying full market. It's just, again, they had a mandate with their fund to keep a portion for affordable housing. We don't have that mandate, so we're going to maximize profits on this asset.
We got a question here. Do you like national property managers or local/regional management? So I would say, you know, as Arnold was just mentioning, I would say more regional. We want them to have scale and ability and systems and processes, but we also want them to be negotiable and want to work with us. When you see, you know, an asset living who has 50,000, you know, a million units, whatever they have, and we're like, hey guys, we're going to structure your incentive this way, they're just going to laugh, right? They're like, no, no. But you find like a you know, well-suited regional, you know, 5,000-6,000 units under management, and you're like, guys, we want to grow with you, we want this. You know, you find they're more receptive, and that's where we could really build a strong relationship with them. So that's the management that we like.
Yeah, that's a great question. It's a sweet spot, I would say. I want to add to that. They can't be too small, they can't be too big. When they're too big, all these terms I told you about, they're going in one ear, out the other. When they're too small, they might agree to everything, but they don't know what they're doing, right? So you want to have a property management company that at least has, you know, I would say 7, 8 assets of similar vintage and size in that same location, so they're familiar with the market, right? They're kind of in that range. That's a really good sweet spot where you know, they're growing, they need our business, they're experienced, and we could structure those deal terms.
Absolutely. Next question here is, what is the minimum investment for Green Tree?
So 100,000.
Aligned equals property manager in-house or external on acquisitions till they fail. Yes, we're going on this Green Tree third-party property management. And that's where we just negotiated that incentive structure Arnold was mentioning with this deal. But as he also mentioned, we use the same property management systems and software that the groups that we choose utilize. So in the event that, you know, is in a dire situation and they just were not performing, we would have the ability to just step in and transition without any disruption to the tenants, and we could take over. And
I can tell you this, the guy Roman at this property management company, I think he might feel like he went through an IRS audit by the time I was done asking him questions and going through every workflow. So I'm confident we're making the right choice, but we always got backup in case we don't. And hopefully we don't have to send Tyler out there for Valentine's Day again.
Absolutely. Yeah, the old Texas Roadhouse dinner in the country. You got it.
That was classic.
Was Green Tree hold 5 years anticipated hold period, right? So that's a question. All right, I think that's all the questions. Anything else anybody have? You know, give another minute or two and drop it in the chat. But I think that's
well. Thank you, everybody, for joining. Would love some feedback. I know our marketing people are going to send a little survey out. If you could just give us an honest opinion, right? We want to improve. We want to continuously deliver more value and improve our educational material. So again, thank you for your time, and hopefully we delivered value to everybody on this call.